One potential capital budgeting decision that may be made is the decision on whether or not to replace some assets that you have that are actually currently in place and working. And so one of the potential benefits for replacement is increased production, which may increase revenue. So newer assets may be able to produce more in that they may be able to produce whatever product you've got more quickly. You could also have increased efficiency, so it may lower the cost of whatever you're producing. So there are several things to consider when you're making a replacement decision. One would be salvage value from an old machine. And so you may have some cash flows coming in from selling off an old machine or its parts, or you may have cash flows going out for asset disposal. Other things to consider are some of the benefits that are listed on this slide. So you may save some money, you may reduce your costs because of added efficiency. You may also increase your revenue because you're able to produce more and then sell more as well. You also have to consider incremental depreciation effects. And so your new machine will have depreciation expenses associated with it. And so you can incorporate that into your capital budgeting analysis. So here's an example. We've got some equipment we're trying to decide whether or not to replace. The new equipment costs $2,000, but it's going to be more efficient than the older equipment, and it's going to reduce cost of goods sold by $1,100 per year. Our old equipment is fully depreciated, but it can be sold for $200. And so there's going to be some salvage value implications here. The book value of the equipment, since it's fully depreciated, is going to be $0, but we can sell it for $200. So we have a capital gain there that's going to be taxed. The new equipment is depreciated over 3-year life using makers. And so this is the 3-year makers depreciation schedule. Our working capital needs aren't going to change at all. And so when we're calculating free cash flows, we don't have any working capital needs to worry about. Our tax rate is 35%, cost of capital is 9%. Our question is, should we replace this machine? So what we could do is construct the same sort of pro forma income statement that we learned how to do earlier in the chapter. We have incremental cost of goods sold being reduced by $1,100 per year. And so our incremental gross profits are going to be $1,100, a positive number for years 1 through 3. Our depreciation expenses are built in. We compute EBIT, then taxes, and get down to incremental earnings, just like we did in our pro forma income statements previously. So once we get to incremental earnings, we have to convert to free cash flows. So we add back our depreciation, subtract off the purchase of equipment, and then we're down to our salvage cash flow. And so the book value of the asset we sold was $0, but we were able to sell it for $200. And so our after-tax salvage cash flow is the sale price of $200 the entire $200 sale price is a capital gain. Because remember, a capital gain was the sale price minus the book value, but the book value in this case was 0. Our tax rate is 35%, so 200 times 0.35 is going to be our tax expense. And what that amounts to is an after-tax salvage cash flow in year 0 of 130. So we would put that into our analysis here. So for our incremental free cash flow, we start off with our incremental earnings, add back depreciation, subtract off our purchase of equipment, and add that salvage cash flow of 130. Get 1636.69 as a cash flow out. To decide whether or not to take on this project, we want to compute the NPV. Our discount rate, our cost of capital for this project, is 9%. And so if we compute the NPV, we get 585.95. That's greater than 0. NPV is positive. So our decision is to replace the machine that we already have in place. Now, in this example, most of this pro forma income statement and the conversion to free cash flow is just shown here and given to you. But this is something that you should be able to piece together based on what was learned earlier on in the chapter.